Earnings, we talked a lot about earnings last week, ate a lot of pizza, did all that good stuff, drank a margarita. It's kind of what you have to do during earnings season just to stay sane. But going to highlight a couple companies. I'm going to start with you, Sam, while we're on the topic of food and earnings. Del Taco, ticker Taco, TACO, a position I think you and I own in our personal accounts. I don't think any clients own it. Correct me if I'm wrong.
Yeah, we have one account.
Shout out to that one.
Yeah, sorry for that one account. But no, Del Taco, good company. They basically are like in between Taco Bell and Chipotle. And that's kind of what they're pitching themselves on, is this QSR plus, the quick service restaurant plus. So it's not quite McDonald's or quite Taco Bell, but it's also not quite like a Panera, who's like considered fast casual. It's right there in the middle. And so I think it's a good position to be in. But they come out, they've just quarter after quarter, they do really well. They've only been public for, I don't know, about 2 years or so. They come out quarter after quarter with strong results, and then this quarter we were looking at thinking they were going to beat on earnings, beat on revenue. Well, they come out, they do beat analyst estimates on revenue. They come out at about 111 million. Estimates were 110 million for revenue. They meet on EPS. So I believe it was 13 cents a share is what analysts were expecting. So that's great. And then you see this all the time with companies during an earnings report, is that it's almost all reliant on guidance. So if you have a bad quarter, but you raise your guidance and say we're going to do really well for the rest of the year, then people will buy the share up. They'll buy those shares. But the opposite is true, is if you lower guidance, then a lot of times the market will punish you. And that's kind of what happened to Del Taco. They didn't lower guidance. They narrowed the range of their guidance, which I don't think was really bad. I thought they had a really good quarter. They come out, they're lapping one of their most successful quarters a year ago when they launched their main product, the Del Taco. And
Del.
Yeah, and so I thought they did really good. They posted, positive same-store sales comps. I believe this is the 17th quarter in a row or something like that. Just strong performance year after year. They've gotten hammered. They went down 20% after the earnings call, which is tough. I think that's overdone, but you've seen the last couple of days since the earnings, it's like somebody buys them up. They've opened up like 2% every day since, and then at the end of the day, they're roughly flat. It's like the market just keeps pushing them to about $12.50 a share. I guess the market's just waiting to hear a little bit more news before they start buying them up again.
There we go. And two more companies we're going to hit on today, American Express, IBM, positions that are a little bit more widely held across narwhal portfolios. Ben, what are your thoughts? You can lead off with either one or both, whatever you want to do.
Yeah, well, let's start off with IBM. By the way, before I get into this, if you haven't tried Del Taco, I would highly recommend it. In fact, go to Del Taco and buy everything you can eat, and then more, and then go to another Del Taco and do the same thing, because we need to get that revenue up.
And point of
especially
note,
for me and Sam's portfolios.
they just launched queso, and their queso is supposedly much better than Chipotle's.
So buy all of it.
That's not saying much, though.
Yeah, it's a low bar.
So let's start with IBM. I think, Sam, you mentioned 17 straight quarters of positive revenue growth. And if you flip that, let's talk about IBM, which just reported its 22nd quarter in a row of revenue declines. Big Blue is, in the big red right now. But it's all an expectations game when we're talking about earnings. If people expect IBM to lose revenue, then it's not going to be a shock when that happens, and you're not going to see the stock probably go down as much. In fact, what happened is IBM actually lost less revenue than people thought it was going to this year, and sales were a little stronger than people expected. As a result, the stock really flew. I think it approached 160. It might still be around there. And the reason for this was because they just came out with a new mainframe, which is a high-functioning computer. It's called the Z14. That's really boosting sales. And importantly, a lot of times what IBM does is they kind of juice revenue and juice growth by buying other businesses or fudging with the accounting. This time there was an absence of that. Organic growth, which means what IBM is doing exclusive of things like acquisitions, was was a lot stronger than I had expected and what it has been over the past number of quarters. And as a result, IBM's shares did really well. This isn't to say IBM is the next Microsoft, but it is to say that they now have this big product, the Z14 mainframe, and it's subsidizing the cost of new growth in areas like blockchain and software and cloud computing. So
I think it's very easy for them to move around that revenue in different segments. Like they have certain segments that are just like dying, like negative 10% quarter over quarter, and then other, their strategic stuff and their cloud stuff that's up 15. I mean, I think it's super easy to move stuff around to make it look like it's this growth company now. Yeah.
But it's a bizarre company. You know how most companies, like,
it's complicated.
If Narwhal were to do financial statements and announce them publicly, we'd probably have Core Asset Management, Tusk Media, and things like that. Instead, what IBM does is they group these random businesses and call them strategic imperatives, and that is the business segment. I don't know how it's managed or whatever, but they call that group, the business segment, strategic imperatives.
And it makes the analysis really hard when you have that much stuff to look at. Like, they can hide so much stuff if they want to hide so much stuff. Like GE, you're pretty much seeing that I don't want to get into GE, but you're kind of seeing just a lot of cockroaches that, as an analyst from the outside, you just can't find.
Yeah. Unfortunately, I've been finding way too many cockroaches in my apartment lately.
Sounds like a personal problem.
On the American Express side, so moving from IBM to American Express, everyone knows they lost the Costco contract. This is why you can't use your Amex card at Costco anymore. So there's a big shift in that credit card base. And what they're doing is they're cycling over it now. So you're seeing a maturation of these new consumers who are of inferior quality to the elites, the Costco customers. And as a result, you're starting to see that loss rate and the delinquency rate tick up a little bit for Amex. Personally, I don't think this is a big deal for them. That's opinion, not fact. I think that they're actually executing to the plan pretty well. They raised guidance. That guidance raise was fairly expected, but I expect that the momentum is going to continue into 2018 as long as the macro space in the United States remains strong. Interestingly, when we talk about Amex, a big portion of their income comes from international, which I think a lot of people forget because, it does have America in its name.
It's a great point.
I'll just say my issue with American Express is that, like you said, now that they're going after the lower tier people or customers.
Like me, I now have an Amex card.
I have 4. But because
not kidding, folks.
I'm not kidding. So that kind of changes your portfolio, like risk characteristics. Like you said, the charge-offs are going up. So I think that the argument that American Express deserves this premium over other card issuers is less than it was before, in my opinion. And a lot of those new customers they carry balances. They're not charge cards. So American Express is now carrying that risk of being repaid, where before it was more just like 1 month, because charge cards are different because you have to pay that off in the month. Credit cards, you can carry that over as long as you want.
Right.
So it changes their risk profile, in my opinion.
Mm-hmm. Mm-hmm. There we go. Interesting earnings updates. We'll have tons of earnings coming in the next couple weeks still.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.